All right, we are moving on with our next panel. VC funding in the crypto space, the blockchain space, can kind of tell you the ebbs and flows of what's going on with the markets. Are we in a bull? Are we in a bear? You look at the VCs and see what they're doing, and maybe that'll give you a little bit of a clue on where we're at. Right now, we have our next panel talking about what is the current state of VC venture in the space and how do we progress from here. Moderating that space is Filippo, Chisaro, and please welcome the panel and Filippo.
All right, everyone. So yeah, welcome to the amazing panel. I am really excited to have these great investment titans in our space join us today. So we'll do a quick round of introductions and then we'll start with our respective questions that are addressing where the future of Web3 is in terms of investment. And yeah, so would you like to start,
Sure.
please?
Hey guys, good to see everybody down here, everybody in this heat. My name is Ben Lakoff. I'm a GP at Bankless Ventures. You're probably aware of Bankless, which is a media company in Web3. We've just launched a Web3 fund.
Hi, I am Jason Fang. I am the managing partner at Sora Ventures. We're based in Taiwan. I've been investing since 2015. I started at Fimbushi Capital and then started Sora at 2018. So yeah, we're about 70 mil AUM, invest in almost everything. So yeah.
Hey guys, my name is Karan Gandhi. I am a senior associate at Cypher Capital. We're a Dubai-based blockchain-focused fund. Been investing in blockchain startups since early 2020 and predominantly come from the Bitcoin mining space, operating around 10% of worldwide hashing power.
All right, so if we want to know about what's going on with Bitcoin in the next bull run, which we started to say is a self-fulfilling prophecy, you should listen to these two guys because they're the giants here. But yeah, we have really good representation from all over the world. We have the US, we have Asia, we have the Middle East, and we have Europe. I'm Filippo, the managing partner of AgileGTM, which is a Web3 accelerator fund based in Lisbon. And we invest in enterprise adoption of Web3. And glad to have you guys here with us today. So maybe let's just start with a more generic question, and feel free to, hop in and answer, and also have a debate between you. So let's start with the state of venture. What do you think are the top industries? What do you see are the top industries today that are getting funded or that are seeking funding, and where is the demand coming from in the space? Would you like to?
Oh yeah, sure, yeah. I can start. I think so as a fund, the way we look at things, we bucket things in like two main categories. Like we are still agnostic fund, but we bucket it in infrastructure and consumer tech. The way we kind of look at infrastructure is anything innovation, EIP upgrades, capital efficiency stuff on the DeFi side. Anything that helps improve that whole sort of side of that vertical, we probably deploy capital in that side. And on consumers, it's pretty broad. Anything that brings in adoption or user base, in simple words, to this ecosystem is something that we will be pretty excited about. So generally speaking, the industries that we look at it constantly are evolving. I think Web3 in general has been evolving since, got out from 2017 onwards, like from the year of ICOs to the year of infra getting picked up from the Solanas of the world, picking up in 2020, to the next season hopefully being about adoption. And for us, I think the main core industries that we are excited about is RWA, MEV side. We're also excited more on capital efficiency on DeFi, so not the core foundational products, but more sort of new ways of moving your money around, in simple words. And also in infra side, we're very excited about interoperability, which we think is kind of the place to be because there's so many L1s and L2s that we need more we need more toolkits to move around so that everyone can smoothly transact. Yep.
So we represent Asia, and so our biggest value add is really trying to build a product that we believe will be a good fit for institutions. So We're open-end fund, which means that generally, like these guys, I'm sure you guys are mostly closed-ended fund, like VC funds. We actually invest in the primary market, and we'll also invest in the secondary market. But our skill set is all in the venture business. So for example, we will invest in a primary round private sale. It gets listed, the price goes down, we'll buy more. That's our kind of our strategy. And for us, we're looking at 4 sectors right now. That's more relevant today. One is the Bitcoin ecosystem. So these are ordinals, BRC20, BRC21, anything to do with Bitcoin ecosystem, UTXO, we're very interested. We've made about well over $6 million USD in the last 2 months, so we're very bullish. The second thing is encryption. I think encryption drives utility, especially in the institutional space. So we believe that's going to be an area that will obviously attract a lot of utility moving forward. Every bull market obviously needs to be justified, and we do believe that the next bull market will be highly dependent on how much utility we can bring to users, to retailers, and to institutions. So that's an area that we're looking at. Other things that maybe people here might know, might not know, I'm sure you know very well. Decentralized science. It's sometimes people refer as DeSci. So I've been investing in categories of science back in 2015. But at that time, there was no concept of tokens, right? This was before ICO, this was before NFTs. And so we would invest in companies under the category of science. So this could be biotech, healthcare, IoT, hardware, software, anything, right? And they'll use elements of blockchain. We believe that that's going to be a potential low-hanging fruit. We don't know, but we're betting early. And the last category we're investing are standard things, so like NFT utility and DeFi infrastructure.
Yeah, so I'll zoom out a bit and state of venture. So I have some stats. In 2018, the global amount of capital raised for crypto VCs was 3.3 billion. 2019, also around 3.5 billion. 2020, 5.5 billion. 2021, who thinks it was higher than 5.5 billion? Raise your hand. Yeah, it was $14 billion in 2021. How about 2022, higher than 14.4 billion? Yeah, it was bananas. We raised $21.6 billion. All right, how about in 2023, higher than $22 billion? Anyone? Yeah, the chart is insane. It falls off a cliff. It's like depending on where you look, less than $500 million. So in terms of state of venture, crypto is no longer the sexy new, only shiny new object that all the VCs are frothing after. There's now AI, there's a bunch of other cool stuff that's happening. There's some macro things at play, obviously. But I think at the highest level, the amount of capital that is flowing into VC funds this year is drastically smaller. That doesn't mean that all of that capital that was raised in subsequent or in previous years is all deployed. It's hard to tell. There's probably a lot of spare dry powder sitting around for a lot of these VCs, but in general, less new funds, new LP money into the VC market. So that kind of has a trickle-down effect into VC as a category overall.
Yeah, fair point. Amazing. Yeah. Okay. First of all, I'd like to have those stats. I'd love to send them to me.
So I didn't prepare this for the thing. I was actually just showing somebody right before this, and I figured it would be great. So we just did our first close this year, and we raised almost $30 million. So roughly 10% of the total capital raised this year for our small fund for the first one.
That's amazing.
Yeah. People kept saying it was hard, and it was very hard, but
That's why we want to. It's great to. Yeah. So I just wanted to say. So you all mentioned really interesting things. So Ben, you mentioned obviously how the investment in the space has decreased, and new sort of the new cool kids in town coming into play now, and that the investment has, gone down. But that is because potentially we have not achieved product market fit in our space, right? And it's an elusive concept in a way. So maybe I want to take you to that conversation and to hear how you see product market fit come into that, which is also what you kind of mentioned. It's like, okay, the products that are out there today, potentially in the last year was infrastructure, and then it moved into investing into dApps, and you said DeFi, gaming, NFTs. These are the ones that, most layer ones are focusing on that now. But how is this transition happening to focusing on real problems that solve, solutions, that solve real problems, right? That's kind of what I'd like to hear from you guys.
Yeah, sure. So I think with any sort of industry, right, there's a huge amount of speculation in the beginning, right? We see that in crypto, it's pretty often, right? A lot of speculation around projects. And I don't say that it's still normally very hard to find product market fit, even in general industries, right? In Web3, I think the main challenge is that there's a lot of copy paste. There's not a lot of innovation. I think if there's more innovation, funding still happens. You will still see, state of venture data is that's amazing, but you'll still see some projects in this market, and we don't call this one a bull market though, but even in these markets, there are some projects that are extremely oversubscribed, and there are some that are just trying to get their first check, and they're struggling hard, right? Maybe it's not the right product, it's not the right innovation, maybe it doesn't make sense, it's too early, whatnot, right? Generally, also in crypto specifically, it's hard to also put a metric for PMF. Like in Web2 side, all the funding happens based on milestone, right? So it happens on milestone, so seed, Series A, ABCD, whatnot. Here it's much more short-lived in terms of fundraise. Go-to-market is very quick. Time to TGE is very quick. So it's hard to put things together, right? And also the biggest problem that we all face and probably would have faced is that what do we count as PMF, right? Is it user base? Is it TVL? Is it in devs building on your product? It's just a random question.
How do you measure success?
Yeah, how do you measure success, right? We're too early. But a new chain, say, having 10,000 devs building on top of it, and you can verify all of that on GitHub, does that mean that's going to be the next successful chain and you will deploy your hard-earned money on the products that they build? Probably not.
It's, chains now are, the way they see success is obviously projects that are built on top of their chain and whether they are successful, but actually we haven't solved the scalability problem,
That's
which is
my
what we're
point,
having. Yeah.
that even if a chain comes with 10,000 devs, from certain community, migrating them to this ecosystem, it's not necessary that it'll be a success. So it's a bit hard to kind of quantify that. The ways I think what the whole purpose of at a VC level that we normally kind of look at is understanding whether there is a need for that, right? Again, it's all about the problem that you're trying to solve, right? In terms of market sizing and TAM, it's a bit hard because, you will market size something for today and you put a thesis together and then you look for projects in that sort of thesis. But I think every season there are some new problems that are emerged and there's some new products that solve that. So 2017 was different, 2020 was different, next season will be different. And product market fit as a question is an evolving thesis that you just try to build your internal parameters, figuring out, okay, this makes sense, this doesn't. Like in DeFi, we have market cap by TVL, which everyone uses, but I don't know, it's, you still find a lot of projects being overpriced with extremely crazy lower market cap to TVL numbers, but they still got the hype because of community, so it's pretty
Yeah, we were talking
crazy.
about that earlier, how the maybe going back to what Jason was saying, you mentioned valuations quickly, right? And I think that the space is moving from going to investing in tokens, right, to actually buying equity. That's the first transition that I think is happening, right? Buying more equity or more sensible projects that actually looking at metrics, success metrics going forward. That's the first thing I think that we kind of spoke about. And in light of that, there's also a bull run that's somewhere. We all live in hope that it's happening at some point, but we know it's a self-fulfilling prophecy, and we also know that it's going to be curbed a bit by institutionalization or institutional adoption happening under the hood. Yeah. So I wanted to ask you what you think, what's happening with valuations at the moment. How do you see this affecting valuations? What I just mentioned, the idea that institutional adoption is coming, the idea that we're now buying equity instead of tokens, and that we're not, pumping and dumping. Like the space itself is changing. The way rounds are structured is changing. So I'd love to hear from that a bit more.
Yeah, so we're based in Asia, and the truth is most Asian funds are down right now. And I think part of the reason is because a lot of the fund manager, even though they are experienced in the Web3 space, they lack experience as fund managers. And so I'll give you an example. Our fund, when we first started, we were ETH maxis, like you guys. And we held ETH all the way. We held ETH from 1,200 to ETH to $80, and then back up. And that process is actually very difficult, especially as fund manager, because you have to explain to your investors. Remember, this was a time when HXCC wasn't around, Sequoia wasn't around. I mean, no one knew ETH was going to come back, right? So it's hard, it's really difficult to get people like LPs, your investors, to put money back in you after going through, minus 80%. And that's what we're seeing right now with a lot of funds in Asia. And for that reason, they're not deploying as much, right? When will we see more capital coming in? I think most likely the bull market. But realistically, if fund managers have actually done their job, sold or allocated or try to get some portion of their money back during the last bull market, I think our market would be in a much better shape today, right? And this is why I'm saying it's like utility developers, they'll always build, regardless of the bull market or the bear market, they're still doing their job. Great projects are still, they'll still get funded, regardless. It's just a matter of valuation. So because of the market we're in right now, valuations are down, but that's actually depends on what you're looking at. For example, if you're looking at Bitcoin right now, Bitcoin valuation is anywhere from $1 million USD to $5 million USD. If you're looking at Ethereum or any non-Bitcoin, it's usually around 15 million USD to anything as high as 50 million USD. 50 being the more expensive.
Yep.
But the most important thing here is, even when we're investing, is the minute we invest, we kind of already know when to exit. Is this a deal that we can exit in 2 years? Is this a deal that we invested in deals that we dump on day one, and we got our money back on day one. On day two, we start taking profit. And then for us, we also have deals where on day one, until they got listed on Binance after 2 years, we diamond hand, like just held all the way, and we bought more in secondary. So it's important for fund managers to realize what you're buying and then when to sell. A lot of people are good at buying. You go to these conferences, you speak to a couple CEOs. As long as you're hardworking in this industry, you go to a lot of conferences, you speak to CEOs, you'll generally hit some profit, right? But the difference between the good and the really good fund managers are when to exit. And so my job is to obviously, one, make sure that my investors make money, but at the same time, hopefully share some experience with other fund managers, and hopefully at the same time, everyone makes money. Because if everyone makes money, the industry grows, right? LPs come in, institutions come in. But more importantly, we see a real growth, a real trust. At the end of the day, your money or your AUM, however amount, whether that's 30 million or 70 million or whatever amount, that number is the level of trust you have with your investor. The more you can fundraise, the more trust you have. It's true for funds, it's also true for projects. And so right now, there's not a lot of trust in our industry, but it will come back eventually. And for us, we're doing our best to support on investing the best entrepreneurs that bring utility, concrete use case into our industry. Yeah.
I'd love to time this microphone. I'd love to hear your opinion. So you brought the idea of trust, and I'd love to ask your opinion. In light of what's happening in the U.S., especially now. So I'll start by saying that from my personal and humble opinion, being a fund manager is one of the hardest jobs there is out there in the world, because if raising for a product is difficult, raising for a fund is 10 times harder, because the only thing that you have is the trust that you can infer to others by saying we're going to make the right kind of decisions. But the other side of it is also, sourcing the best possible deal. So I'd like to hear from you, first of all, the relationship between the two, how you translate good deals that obviously in the US, potentially the best deals are still, even though Web3 is a global space, US deals are supposedly the best US deals. The best ideas still come from the US to date. And how that is translated into trust in light of the fact that, in the US, it's a mess right now from an institutional standpoint.
Yeah. I mean, ultimately, we run an early stage fund similar to Sora, so like at the earliest stage. So a lot of it is founder backing. So, is there the founder market fit? What is that founder's why? And we talked a bit about evaluations, but like valuations have gone down. Okay, well, it's probably easier to make more money as a fund manager if valuations are more compressed and there's not a bunch of money chasing a few deals. There's still smart entrepreneurs coming into the space, building the next pieces of whatever this next bull market would look like, or whatever the next version of the new internet looks like. So in terms of sourcing deals and then kind of winning deals, well, sourcing deals is just kind of your network and who you're talking to. But in terms of like winning deals, yeah, it's not as competitive as full-on raging bull market, crazy valuations, everybody trying to ape into things with little or no due diligence. But it's still like the founder, and for you founders out there, I mean, you guys should be the ones in power here. There's still a lot of money chasing smart founders, and like, don't be afraid to like negotiate what you think you're worth. Fundraising's hard and difficult and arduous, and it sucks. But like, don't sell yourself too short with your valuation, because ultimately, if these things work, I mean, the way that venture works is it's power laws, and there's going to be a small sub 20% of your entire portfolio that makes up for the rest of them not doing much, if at all. So, yeah, I mean, in terms of like, how do you win deals? It's no longer just money. There's a lot of VCs that have money. So it's adding value in other ways. And each kind of fund needs to have their unique value proposition, similar to how startups are pitching themselves to other startups in their cohort. You can't just be a big wall of money giving people, well, you can, it's called SoftBank, but we don't have unlimited money, I guess. So yeah, adding value and the value add that VCs do,
Yeah, I think we're moving into, I agree with you, I think we're moving into this kind of new, the modern way of looking at VC, right? It's like servant leadership in a way almost, where it's like servant VC in a way, it's like servant venture capital, where you're basically, you're actually selling yourself, you're at a point where everyone has money, dumb money, anyone can that's just money. It's about actually the value add, and I find myself in conversations when we're sourcing, it's like I have to sell myself. It's like, oh, this is how we're better than everyone else in the value that we provide, and I find that is exactly what you said. It resonates very much.
And founders should view your investors as like this dream team superstar, everybody with their own superpower. So maybe it's a better geographical focus. Maybe it's help with distribution. Maybe it's strategic intros. Maybe it's just that name that adds a lot of social proof, social capital to your startup. Maybe it's just money. There's a lot of different roles within this quiver that can add value, unique value to your own unique startup.
Ashley, I just want to add, I think it's actually easier to manage your fund that is a lot smaller. So I think 30 mil, 50 mil is actually, the GPs who raise 30 and 50, they're really smart because it's a lot easier to manage. I think one of the reasons that A16Z is not willing to put in small check size is also because their brand is too expensive, right? So they're only interested in large check size because their AUM is so big. And they're also thinking themselves, like, are we going to be they're trying to be the leader for pushing the next phase, right? But honestly, our industry is still early.
I think one thing that, this is such an interesting point, like 30 to 50 mil kind of a range. We sit at 100 mil, and what we've seen as well, it's through point. As the capital AUM grows, it's harder to make that same network effect, and then obviously the overall AUM doesn't grow as much. What we found a way to kind of make it work was our core business has always been Bitcoin mining. So we kind of deployed our fund, a good chunk of that in mining, which generates cash flow. And even in a bull or a bear, we're still investing, but just talking on that valuation bit and how that's changed completely, and value add in general, I think that whole value add selling point is mainly because there is more money in Web3 than more founders. Like it's actually a better game. It's the opposite way around. In the Web2 side, I don't see many VCs going out and selling themselves about the value that they offer. But in Web3, it's so critical that what are you going to bring to the table? So in any scenario, don't be afraid. Just keep going and speaking to VCs, and the right one will click.
Yeah, I mean, I love fundraising from the bear market. It's the best.
Don't you guys think that will change though? I mean, the idea, what you mentioned right now, it's like, because founders today don't just want, like we said, they don't want money because potentially like a gaming company could start by launching an NFT collection, and back in the day when they started, they could have done 2 mil overnight in 3 hours, and so they don't need 2 mil to build the game. But we still need. I still think going back to the idea of value, we still need to move away from making founders understand that it's not about building for the sake of building. It's building for someone, and that someone needs to be identified successfully, and that's where the value add is, I think. So yeah, I'd love to hear your opinion on that, and also what you mentioned for you specifically, is very often you are in the transition between using some of the money that you've made through token sales, right? And using tokens and then redistributing it. Again, the whole token equity play, right? Because many of you, for you, for example, you're using the BTC that you've been mining to using the fund and so on and so forth, and some of you've been using SAFTs to kind of get that return. And so, how are we transitioning, and how are you guys seeing that happen?
I think I can share a bit. For us, it's just a bit different on the benchmarking side. I think every fund uses usually CCI 30 as a benchmark. But for us, because our capital source is not fiat, it's BTC. So our benchmark is BTC, which is extremely hard to beat. So that's one aspect that we look at very closely and figure out how to kind of balance ourselves. That's why we've got one leg on the mining side with the fund and one leg on the venture side. And I think this whole value proposition and value add, all that was not something in 2017, 2018. No one cared, right? So like, you could raise 10 million on an ICO and it's just nuts. I think this whole narrative changed because everyone is becoming more serious in the industry. They want to innovate and get the right people. They don't want dumpers, for example, or they don't want someone who's not the right partner, right? And I think every VC, even on the panel and everywhere, are trying to find their sweet spot on what they are good at and what can they actually offer. And find that sort of a sweet spot. Yeah, sure.
What was the question?
I was asking how you guys are
value
going between token, the balance between token and equity within your fund.
I just want to add one small thing.
Yeah.
Between, so I missed that. So between token and equity is, I mean, before we had all softs, right? But we had this whole equity narrative. Don't raise in token, it's bear market, it's hard. Actually, what we look at is where the value accrual happens. Like if you're a SaaS business, right, building something in Web3, you probably don't need a token, right? Even if you're offering one, right? So what we do check internally is that where does your value go? Where does your revenue go? Does it go to your bank account, which is equity? Or does it go and drive back to your token? It could be both, like 50% here, 50% there. It depends on how you structure the company. And that's when we really see that does equity matter or token matter? And should we take a hybrid exposure, which means I need both, or should I just take a token versus only an equity exposure? So that's a very clear, it's obviously case to case, like if you're building infra versus a product, and yeah.
So the question is about equity and token, that ratio, right?
Yeah.
Yes.
Yeah, so for us, we actually have a very unique business model where we invest in media companies or community development companies. What that means is that, so we're investor in, we were invested in The Block, we're investors in Bitcoin Magazine, we're investors in CryptoSlate, we're investors in Forecast News. They're all media companies. And what happens is, generally when we give money away to these companies, we don't expect any form of return. For us, it's almost a losing business. I mean, you look at media compared to all the other sectors in the world. Media is by far the hardest company to make money. And that's why I guess Forth was sold to Binance, right? But the point here is,
Creative industries in general, yes.
right? I
it's
mean,
like-
but you need people like VCs for us to fund these media companies, because at the end of the day, they're playing by far the most important role in our industry, which is education, right? Whether retailers, if that's a positive learning or a negative learning, it's going to affect their entire experience in this industry, right? So if you're really looking to build long-term for the industry, you should be investing in that sector, right? That's how we think. So when we write, 500,000 check size to these guys, we're not getting it back, and that's in the form of equity deals,
Yep.
right? The media companies don't launch tokens, right? And then of course we have the token side, which for us is about 30 to 40% token investment. Usually now it's equity plus token warrant, and then the remaining is mostly liquid asset. So about 50% of our books are USD trading back and forth, buying distressed asset, things that we think has opportunity, aligns with industry trends.
They could launch an NFT collection though, like VaynerX and VFriends.
We do buy NFTs as well. I mean, we have the only black and white board.
Oh, it's just-
Yeah. So.
So yeah, we have. Sorry, Ben, did you want to add?
No, I mean, I'd just add, there's the kind of more common thing right now, I'd say, is like a safe or an equity round plus a token warrant or a side letter. But founders, talk to your legal, like a side letter and a token warrant aren't the same. There's different kind of legal things to think about with each of them. So kind of gotchas, landmines. So that would be the thing. And it's just value accrual is a big one.
Yeah, I was going to say, I think that in early stage in general, there's this idea where everyone that's building a startup in Web3 needs to launch a token. And I think that we're at that place where, you either have a business and potentially you have a token economy that is an added value layer that sits on top of it, but it is not a must, and it should definitely not be used as a vehicle for raising if it's self-serving. Like if it has no purpose or it doesn't add any value to the business itself. And I think that's it's just kind of sums up what you guys were saying. But
well, and
I'd love to.
there's some regulatory considerations, right?
Right.
I mean, it'd be very easy to have these things accrue direct value and distribute dividends and stuff, but crossing some real clear regulatory lines. So, there is the case to be said, if there were a little bit more clarity on some of these things, you could have some much more interesting, intricate token designs that could really accrue the value.
Yeah. I was going to, maybe we have 2 minutes left. I was going to ask if the audience wants to ask a question. If not, I have my questions. But I'd love to hear if anybody wants to ask a question. So just raise your hand. If you do. No?
Maybe your question?
No?
Rick?
Okay, so I will ask a question. So maybe in the minutes left, in a nutshell, if you would be able to say what's the single most important factor that you look at when you're investing in founders? What is the thing that makes you go, yes, yes, no, no, I want to hear more beyond the deck or beyond meeting them, one time?
Yeah, I've got a very funny one. But my theory is that I've been investing in Web2 from last 7 years, but on the Web3 side, I still follow the same process. I want to know beyond the project. Who are you? Why you're doing this? And are you here for speculation, or are you here for building something? Even if the token doesn't work out, but you're passionate about it, you've got that consistency mindset, I want to put money behind you. Because we'll figure it out. No one has figured Web3 fully out yet. So that's how I kind of...
So if you're here to make a quick
Passion.
cash grab, it's a no. If it's passion and I see the passion, we invest.
Yeah, I mean, cash grabs, so many, but yeah.
For us, when we invest, the most important thing is, does this project, what they're doing, align with industry trend? Does that align with what the industry need in the future? Right.
Of course.
Yeah, for us, I mean, it's founders, and I think there was a VC in the crypto space, I forget who it was, but it was kind of a friendly, said they're about that life. And yeah, it's founding a startup is hard, man. It's Steve Jobs said, it was sitting in the abyss, staring off into the darkness alone, eating glass. It's not pleasant. So you want to make sure that founder is going to stick through it. And you're probably not going to get that in the first 30-minute call or just meeting somebody over a coffee. There's a level of trust that takes some time, but it would be summed up as they're about that life.
Yeah.
And it strengthens the relationship also. So you're not a VC and a founder, you're a partners to help out.
Yeah, I think as you all summarize, I think, just like you said, it's about making sure that in that first point of contact, when that happens, there is an understanding of who is behind, this idea, and it's still about the people, but it's distilling whether that these people are going to be able to make it or not in the current kind of mess that we live in. Anyway, thank you all. It's been an amazing discussion. Thank you for our audience, and that's it.
Thank you.
Thank you.
Thank you. Yeah.
You get-